Welcome to episode 31 of the 5-Minute Investor Podcast, where Stockhouse columnists Jonathan Brown and me, Trevor Abbess, each deliver a 2.5-minute stock profile related to recent news stories with investment implications. This week, we're talking about prospective gaming stocks poised to step into the spotlight following Electronic Arts' recent $55 billion go-private transaction. John, where might investors look to mix profit and play?
Investors are looking to where they can put their money now, Trevor. Gaming has done well for shareholders in the past. EA is in a unique playing field right now. So what happens when your public stock goes private? Let's start with the pros. Going private means EA no longer has to impress Wall Street every quarter. That gives them more freedom to focus on making good games, not just good earnings reports. Think of it like Take-Two Interactive. Still public, still under pressure to deliver Grand Theft Auto 6 on time, EA now has some more room to breathe. Plus, private companies can move faster. EA could launch new IPs, make bold acquisitions, or experiment with subscription models without worrying about stock price dips. For example, Microsoft shareholders were happy about its latest dividend increase of almost $1 a share, but actual Xbox users are mad about the Game Pass price increase. But it's not all good news for EA. The deal includes $20 billion US in debt. That could mean layoffs, studio closures, or a focus on safe bets instead of creative risks. When Toys R Us went private, it couldn't grow and pay off its debt, and that put it out of business in the US. We can't ignore the censorship concerns either, in EA's case especially. This happens when the sphere of influence shrinks. But if you're a fan of WWE, for instance, you've experienced its drastic transformation merging into TKO, the Saudi and MAGA influence, the Netflix deal. EA could turn into something that you no longer recognize. The gaming industry hit a major checkpoint, and this is a world map view of the issue. Now Trevor's going to drill things down with more focus and look at a company with a more modest business presence.
Yeah, John. My gaming stock for episode 31 is Overactive Media, ticker OAM on the Venture Exchange. Market cap $39.2 million. The company runs successful esports teams, specifically the Toronto Ultra and Movistar Koi, which specialize in the games Call of Duty, Valorant, and League of Legends, and attract tens of thousands of fans to in-person events, in addition to hundreds of thousands of online viewers. Overactive's efficient management of these teams has yielded a multi-year track record of financial improvements that stands in stark contrast to its competitors, increasing revenue from $14.16 million in 2022 to $27.01 million in 2024, while drastically reducing net losses from $36.93 million to $630,000 respectively. With a healthy $13.36 million in revenue collected in H1 2025 and operating expenses down 12% year-to-date as of Q2, management is confident in contracted higher margin revenue lifting the company into profitability by year-end. Looking farther ahead, Overactive intends to continue fostering profitable growth by strategically diversifying its revenue. Its most recent initiative, Active Voices, is an AI-powered SaaS platform offering real-time translation, dubbing, and publishing in over a dozen languages geared towards garnering market share in the global content creator economy. Despite its progressively improving financial health, Overactive Media stock has given back 78% since January 2022, granting value investors an enticing thesis to put money to work. As always, you can find links to the articles from today's episode in the show notes, and you can find more investing insights on Stockhouse and the market online. The 5-Minute Investor is on Spotify, YouTube, iHeartRadio, Podbean, Stockhouse, or wherever finer podcasts are found. Thanks for listening, and we'll see you on Monday. This podcast has been prepared as part of a partnership with Take-Two Interactive Software Inc. and Overactive Media Corp. and is intended for informational purposes only. For full disclaimer information, please visit themarketonline.ca/disclaimer.